Hi everyone, this is your daily 10-minute business and finance news wrap for this Tuesday, the 23rd of March 2021. I'm Ricardo Gonçalves. Later, 1 year on from the low point of the stock market because of the pandemic, where to now? But first, to an Australian tech success story, Airtasker, the online company which allows users to outsource small or odd jobs, listed on the ASX today for the first time at a 76% debut at the open and closed at $1.05 per share. That is an increase of 61.5%. So for more, I spoke with its CEO, Tim Fung. Tim, congratulations on a huge day one on the share market. Did you expect such a positive response from investors?
Look, as much as the stock price is there for everybody to see at the moment, we're really just focused on the 5 to 10 year journey. And I've actually asked my staff to not look at the stock price screen. And when I see people opening up the apps, I actually put my hand in front of it and say, let's just focus on the next, the next big thing, which is 5 to 10 years away.
I want to ask you about 5 to 10 years in a few moments, but first, you had your mother with you to help you ring the opening bell today. How important is family, and has it shaped the way you do business at all?
Well, my family has been there, so supportive of me over all of these years. I've learned so much from my father, John, and my mother, Mags, who's been really supportive. And to have her ringing the bell with us today was so important to me. I also asked my wife, Modi, to be up there as well. She's been incredibly supportive and part of the journey. But she declined. She didn't want to be, caught up in all of the madness. She'd prefer to watch from the sidelines and be supported from there.
Okay. What will listing on the ASX be able to do for you?
So over the next few years, Airtasker's got an absolutely massive mission ahead of us. It's a $50 billion addressable market in Australia and a $600 billion addressable market across the international markets that we're operating in. But even more importantly today is the fact that we've been able to give an opportunity for our employees and our taskers to be able to own part of Airtasker, which we're really, really excited about. And to be able to do that in Australia is incredibly important.
You mentioned earlier you're now focused on the next 5 to 10 years. Airtasker, for those that don't know, allows users to outsource small tasks. So what will the company look like in 5 to 10 years?
Well, in the next 5 to 10 years, we're really working on a whole bunch of new marketplace models. So we're helping people to be able to outsource tasks and connect with people in their local community in a whole bunch of different ways. One of the really exciting projects we're working on at the moment is a marketplace model called Airtasker Listings, which allows taskers to pre-package services which they can offer on the shelves of the Airtasker store. So we're really excited about that. We're also scaling internationally now as well. So our London market is really vibrant and has been incredibly resilient during this really challenging COVID pandemic times. We've also launched into Singapore, New Zealand, Ireland, and shortly into the United States as well. And the blue ocean opportunity there is absolutely enormous.
Obviously, turning a profit's important, depending on what kind of stage you are in growth. When will you be profitable?
Well, at the moment, Airtasker is operating cash flow positive, and we've been cash flow positive since May of 2020 and every single month since then. We've got gross margins of 93%, so a really, really healthy business model, but we want to keep investing into product development and spreading the word about Airtasker. So really, profitability is all dependent on how fast we can grow and take Airtasker to the world.
You've had the company for around 10 years. Just how supportive is the Australian environment to technology companies like yours?
Well, I feel incredibly blessed by the opportunity that we've had in Australia. We've got some of the smartest people coming out of STEM courses in Australia. We've got incredible product managers, incredible engineers, incredible designers here in Australia. And we've got to be so thankful for the way the world has treated us during this COVID period. So I'm incredibly thankful, and I'm really excited about being able to list on the ASX and be able to give an opportunity for Australians to really take part and own part of Airtasker moving into the future.
Tim Fung there, the CEO of Airtasker, to the Australian share market today, which fell despite a strong open from Wall Street, or a strong opening today on the ASX 200. Ultimately, it fell by 0.1% to 6,745. Travel stocks declining across the board, so to the banks. Some of the miners increased. And of course, it happened on the day when on March the 23rd, 2020, the Australian share market bottomed during the pandemic after that huge 36.5% fall after the restrictions came through. For more on that and where to now for the share market, I spoke earlier with Robert Talevski from Activus Investment Advisors. Robert, the market was up at the start of trade but lost a bit of steam during the day. Why?
I'm not quite sure, Ricardo. AGL and BHP were up strongly. Probably not noteworthy was the task outsourcing firm Airtasker made its debut today. It was up 79% from its list price, so that's done pretty well. I'd say that was a standout today.
Speaking of Airtasker, it's in the gig economy. It's a tech startup. Tech stocks doing well off the back of the US, but are we still seeing this shift away from the sector?
It's been an interesting 24 hours overnight in the US. The Dow was up 0.2%, and the tech heavy Nasdaq was up 1.25%, which is a bit of a different trend to what we've seen since last November. That trend that we've seen, that reversal in sort of the recent value stocks basically doing better than tech. So I think obviously that's a bit of a different trend there, but in our view, we probably still see these sectors that should benefit from the recovery. The likes of the tourism, the resources, the financials should continue to do well. But yeah, a bit of a different story overnight. Let's not forget the banks as well. The best start to a year in history. That massive reserve release and that sort of cost cutting out of sort of technology should continue to support the sector going forward.
A lot of this has also got to do with the future direction of interest rates, or when interest rates will start rising. What's the market saying?
You get the sense, Ricardo, it's still interest rates lower for longer. The US Central Bank last week affirmed their easy monetary policy stance. No interest rate changes until after 2023. Bond yields have stabilised over recent days. The 10-year notes are at 1.68%.
So I guess, can you believe that today marks 1 year since the share market was at the bottom following that big collapse, 36.5% collapse pre-pandemic, right? But it's been a pretty stunning recovery since those lows, hasn't it?
Yeah, absolutely. So ASX 200 is up 49% from that low. The techs are up 130%, the banks 75%, energy 70%, and the resources up 60% from their lows. So I guess if you held your nerve, you'd be doing pretty well having invested in some of those sectors.
One of the corporate stories of the day, it was the corporate story yesterday, that takeover of Crown, an $8 billion private equity bid. Any talk of any other potential suitors at the moment? And do we know what James Packer is likely to do?
Yeah, there's a bit of talk today about a potential, I guess that bid being a little bit too low, and the potential for a new bid to come, emerge, I suppose. Look, I think, Blackstone already own casinos like the Bellagio in Las Vegas, so they've got a bit of form or understanding in this area. I think, it sounds like James Packer will probably hold out for a better deal. But I guess this also highlights the activity in the M&A sector, worldwide, which has really picked up strongly over the last couple of months.
Speaking of that M&A activity, especially from private equity, what does it say about where it's going and who are the likely targets?
So in terms of the sector itself, so 2021 should be a very strong year for M&A activity, supported by a number of factors. One, there's about 1.2 trillion in what we call dry powder. This is capital that's been raised from the big private equity shops, the KKRs, the Blackstones, the Carlyles, the Oaktrees. And, also low interest rates. Most deals have some level of leverage. So having that sort of low interest rates also helps, I guess, in that M&A sector. That strong earnings recovery, which we've talked about recently, that's just another factor that really is driving a lot of this M&A activity. And similar, I guess you can also say similar factors to what's driving the listed market. Takeover targets, things that sort of been beaten up, I suppose you could say, Treasury wines, is one example, maybe AMP to some extent. So that sort of, we might see a bit more of a pickup in some of those takeover targets.
Robert Talevski there from Activus Investment Advisors. That is SBS On The Money for this Tuesday, the 23rd of March. I'm Ricardo Gonçalves. You can follow me on Twitter and Instagram at Business Ricardo. This On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It's not personal advice and it doesn't consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.